Hello, everybody, and welcome to another Cyclical Investors Club YouTube video. I'm really going to try to make this video a little bit on the fly and see how it works. It might fail, but it's going to be about thinking about having a coherent portfolio strategy or investing strategy. You kind of start with the individual investment strategy or strategies, and I see a lot of people that don't really have coherent portfolio strategies or investment strategies. So it's not about whether one is right or wrong, but there's certain things that just don't make sense together. So part of the inspiration for this is a couple things. One of them is Cathy Wood and the ARKK Innovation Fund and those type of investments that she's making. So she's always come out and said this is about innovation. These are stocks and businesses that over the long run are going to disrupt everything, and therefore the businesses are going to do really well and completely transform everything, and that's why they're going to be good investments. So she usually tries to say things are going to happen a little faster than they actually probably are going to happen. But even so, this is a long-term process, okay? And the problem with her strategy is there's nothing wrong with that strategy if you can do it well. But the problem is she has, I just looked it up before I get on here, ARKK Innovation has 55% portfolio turnover. Well, if you're making these long-term investments and you essentially have a new portfolio every 2 years, that just doesn't make any sense, right? If you can tell which of these businesses are going to be the winners 10 years or 20 years from now, and you're investing in them early because they're going to be the ultimate big winner, then you should keep holding them until that happens. It doesn't make sense to sell them and to turn your portfolio over all the time when your goal is to have these long-term winners. So either she doesn't know which ones are going to be the winners, which is what I would say, or her strategy just doesn't make any sense. You know, she's either making a mistake in choosing the wrong ones that she's turning over, or she's making a mistake in not holding on to them long enough if she actually got the right ones, right? So that's the type of thing that I'm talking about. And I see different aspects of it with different people's investment approaches. So you really see it with the growth things. So intuitively, usually when you look at growth investors, people who are investing in newer businesses that are growing revenues, we'll say, faster than your average business, often those investors turn their portfolio over quite a bit and are trading quite a bit, similar to Cathy. And that doesn't make sense for that strategy. You can buy a company in the early stages of its public life because you expect ultimately them to be a big winner down the road, but it doesn't make sense to be trading that all the time, right? So growth investors should really be more buy and hold type investors, right? On the other hand, on the other end of the spectrum, I see most buy and hold investors investing in these slow growth or no growth businesses. They might be good businesses. There's nothing wrong with them, but they're fully mature and they're only going to grow maybe around the rate of inflation, grow their earnings that much. And usually they pay out dividends because reinvesting that money in the business isn't going to help them grow any faster. They've already kind of filled their market. And these investors, the way to a strategy that makes sense for that type of investment is one that buys them when they're on sale really cheap, like the price has dropped a lot because the businesses are pretty stable. And then when the price rebounds, then and if it gets a little expensive, then you sell it and you take profits, right? So that's the type of stock that you should be, trading, or the strategy that you take is probably best if, well, I'll give you an example. Genuine Parts Company, I want to say I think GPC is a ticker. I want to say that they were growing earnings an average of 5%, give or take, when I bought it in 2020 during the March decline. And I think I bought that one pretty close to the bottom of that decline. So that's pretty slow. It's not completely flat growth, but I mean, it's like, I usually figure inflation is 3% on average long term. So whenever I think about it, a growing company should be at least growing probably like 5%. And that's about what they were, 4 or 5%. A little bit over inflation, but they're basically fully grown, mature business, and they paid a decent dividend, which is what they should be, and all that. So the business was fine, but it just wasn't growing very much. And I think when I bought it, it had like a 6% dividend yield or something like that. And within like a year, it had, or maybe 18 months, it had gone up 130%, the price had. And then it got to the point where the forward returns, given that it doesn't grow very fast, were pretty low, because the price had risen so much. So I sold it. So I basically took a business, bought it cheap when the forward returns were pretty high, like 12% maybe. And within 18 months, it had filled up a decade's worth of actual business returns, so I sold it. So, but I think it might even be higher now because so many people are attracted to these slow growth but kind of dependable businesses right now because there's a lot of retirees. And there's a lot of people who have kind of a buy and hold mentality with these. So, on one hand, we have Cathy Wood, who should be buy and hold, who's turning over her portfolio too much. And then on the other end, we have people who should be they should be buying lower and selling higher, generally speaking, if they want to maximize their returns. And they are going buy and hold, right? So they're just the people who are doing the opposite of the optimal thing, right? And so those kind of observations are what led me to kind of create this video, and that's the general setup. So I'm just going to kind of talk about the things that I think go into like strategy and portfolio. I think these are some of the things that I'm pretty good at, just especially when they go against the grain. Like, it's just really logical thinking. If you understand what the strategies are supposed to do, you understand the theories behind them. Probably because I'm a theorist, I think about these type of things and whether they make sense a little bit more than most people. But so there's like 4 main factors here. There's the person's return goal. Okay, what sort of annual returns over the long term or medium term is a person looking to achieve with their portfolio? So if you are looking for market average returns, you can do like John Bogle and just buy the whole market. That would be someone who subscribes to kind of the let's see if I can get it in the screen, a random walk down Wall Street, right, where it basically says we have an efficient market, there's no sense in trying to pick individual stocks, or most people just aren't talented enough to do better than the general market, which is probably more accurate than nobody can, because we know people can. So there's kind of a hardline version of that and a soft line. I think the soft line makes sense if you haven't really studied investing, if you don't really know much about it, you're just starting out. It's probably going to be true that just getting average returns is maybe better than what you'll get at least the first few years that you start investing, for sure. So now I consider inflation kind of always 3%. So it's kind of like average returns for above inflation for the S&P 500 are going to be like 6 or 7%. long term. So that's what you can. If you want average returns, then that is what you'll get. If you just buy the index, buy the S&P 500 or whatever. And if you are a good saver and you don't spend a lot of money, maybe you save so much money that that's plenty of money for you to have in retirement or have to do the things that you want to do. And then it's pretty easy. You don't even have to spend your time learning how to invest and things like that. But for anybody that wants better than 6 or 7% above inflation, then you need to figure out a way to make better investments than the market makes. So that long-term return goal is one thing, and then you got, so in that case, there's four things. There's the return goal, the time frame, the concentration of the portfolio, and the diversification within the portfolio. So with this Boglehead or whatever, they're going to have a 6 or 7% long-term return, or 9 or 10 with inflation. That's going to be very long-term, 30 years, right? Plus, it's going to be, in terms of concentration, it's going to be unconcentrated with thousands of positions, or at least hundreds of positions. And then in terms of diversification, you could do a world portfolio or a U.S. portfolio, depending on how diversified, and then stocks and bonds, depending on how diversified you want it to be. So that would be that approach. So if you're going to try to do better than that, then you're probably going to have a differently constructed portfolio than that. I think that's probably axiomatic to say that. So now we get into, okay, what kind of portfolios can you put together that actually makes sense, unlike what a lot of people are doing right now? And I think we can. I set a bunch of books here to just kind of prompt me along the way as I go through this, because there's all these different ways that a person can go about it, and there's different ways to be successful. They each have their own drawbacks and strengths, and so understanding them all can really help, because in one situation one might work, in another, and so on. So I think I wanted to start off with the classic intelligent investor, right? The value investor, kind of original gangster, OG. Now Ben Graham, he wanted above market average returns, and he got them. I forget exactly what they were, but he definitely did well. I would say, just judging from his approach, that usually his time frames were probably, I would describe as medium term. So he would buy things when they were undervalued and then try to sell them when they were either fairly or overvalued. That usually happens within 3 to 5 years. So I would describe his time frame as medium term on most of his investments. And then in terms of concentration, he was unconcentrated, right? He owned he was really playing the numbers. And in terms of diversification, it's been a while since I've read his book with his own commentary. I think he still was doing that in the 70s. But I think he would kind of just take it where it went. If he could get a good yield in a bond or something, he might have done it. But don't quote me on that. In terms of stock, bond, U.S., non-U.S., I think he was mostly U.S. focused. There were a lot more values around when he was investing, but it was harder to find them. So I would say he's mostly stock, but unconcentrated, medium-term time frame with an above-average return goal. I wouldn't be surprised if he returned 20% a year. So that's kind of a old-school value investor approach, and his approach made sense for what he was doing, right? Now, eventually, over time, once we get into the 80s, the 1980s, there just weren't very many of these opportunities of this type around anymore. So, and really, 20 years ago was the last time, when people are looking for net nets and stuff like that. I don't know anybody that's made a living finding net nets in the past 15 years or something like that. Now, you could do it, but this kind of flips to the other thing. You would have to be concentrated, right? There would be one or two things, and you would have to make a giant bet on these handful of opportunities that would come along. That wasn't Benjamin Graham's approach. His was unconcentrated. There were enough things that he could just place a bet, and then some of them wouldn't work out, but then most of them would, and then he would be fine that way. So that's not really a Benjamin Graham approach nowadays. If you're like a net investor, you're trying to find something whose assets are worth more than the price, the current assets, current price. So again, like people are missing, if they're that type of investor, if they think they're taking a Ben Graham approach, though they're not, because there aren't enough opportunities to be unconcentrated like he was, right? Okay, so the next one I'll talk about are, which I already talked about with Cathy. I mean, people have written about this approach before, about her approach that actually made sense. It's always trying hard to get it in the, right? We have Philip Fisher's book. Now, this isn't an exact, I mean, it was written in like the 60s or something, so it's going to be different a little bit than the kind of tech companies that we have now. But the basic idea was the same, and he took, his big thing was finding these growing business that would just keep growing, even if there was a downturn. You hold them for the long term, so we're, in terms of time frame, we're talking long-term time frame. I would say, if I remember correctly, kind of a moderate concentration. If a business kind of grew enough and it grew bigger, he would just let it grow bigger. So it wasn't like trim your portfolio, which is how I do it too. It wasn't like trim for diversification's sake or anything. If you have a winner and it's growing and it's still spending money on R&D and doing the things that it needs to do, then those are actually the companies that you want. And if the stock price goes down or they have a bad year or whatever, you just don't do anything, or maybe you buy more, and those are these growing businesses that can just hugely scale up for the long term. Those are the type of things that he would buy, and he did really well in the market too. Not overly diversified, I don't think, but so it wasn't like go around the world and find all these things back in the 60s or whatever. It was pretty US focused. But long time frame, I would say moderate concentration, and then the returns would be fantastic, because when you had a big winner, it would just go for years. And if you have 3 or 4 really big winners on a moderately concentrated portfolio, you're gonna be set. Basically, you're gonna beat the market and do well. So that's kind of how I think about that. Now, Buffett says he's like 90% Ben Graham and 10% Fisher or something like that, or maybe 80-20. I think it's 90. So we have the good old classic snowball for Buffett here. So he's kind of a combination of both of those guys, and he's changed over time. He was mostly Ben Graham, and now I think he's actually a little bit more like Peter Lynch, like growth at reasonable price stuff. But I think the key thing is, difference with Buffett is he's willing to go really concentrated. So rather than being moderate concentration or really diversified like Ben Graham, Buffett would put, if he really believed in something, he was willing to put a lot of his money into it. And that's also where Charlie Munger, I had to find a special stack just for his great book, which is expensive but probably my favorite out of all the books I've ever read. Where Munger is even more, he's like, if you already have money and you're wealthy, then having 3 businesses is enough diversification. And Buffett pretty much thinks the same thing. Now they have more than that now, because it's just been so many years since Berkshire's been buying businesses that they kind of build up. And then the other thing is the time frame on holding those is long, right? And preferably they don't always hold them forever, but they hold a long time is the idea. So you buy them when they're cheap, like Ben Graham would do. You want them to be these growing businesses like Fisher would want. So you want to buy those businesses cheap and then hold them for a really long time. And if they get super concentrated, and you're willing to place a pretty big bet on them at the beginning, so that if they grow really well over time, like you expect them to do, then you're just gonna crush the market, right? And so that's how they've done it. A lot of it since like the 70s or so. All right, but it makes sense, right? And they would say you don't need that much diversification. If you're picking the right businesses, you're in the United States, which is business friendly and so forth, and you're already rich. I think you need to be much more careful if you're not already rich. And so I don't have a concentrated portfolio because I'm not rich. Uh, so, and I'm not as talented about businesses as Buffett and Munger. So my talents are a little bit different than them. But the main thing is all these successful approaches make sense. We also have, we have Soros, right? I particularly like his thoughts on REITs. Him and also in Howard Marks's Mastering the Market Cycle. The most important thing is his other book. I have that here too. But the Mastering the Market Cycle is good because it actually has the real estate in it. It explains real estate cycles. Soros was on that in the 1960s. And so I have a REIT strategy that is designed really with these big kind of self-reinforcing cycles that Soros described, and they can run a long time, and then when they peak, they come down really fast. So it's like this long steady run up, just like Ray Dalio's debt cycles, right? It's the same principle. Reflexivity is the word that Soros used, where rising prices help fund whatever sort of action you're talking about, to raise the price even more, right? So you just have these kind of feedback loops basically, and if they run long enough, that you can get these giant cycles. So when I designed my REIT strategy, which really isn't like anybody else's REIT strategy, that's how I designed it, because that's how I feel real estate investing works, right? So and not everything Soros did investing wise revolved around that, but the concept is pretty important. And if you can understand that and figure out a strategy that kind of works around that. Now I have a cyclical investing strategy for cyclical businesses that works exactly on the same principle, except for it's a shorter time frame. Usually it's like 3 to 5 years, right? So if the earning cycle or debt cycle or business cycle, if these cycles are running like 3 to 5 years, then a really cyclical business will also have usually earnings that follow that, and then the price follows that even more. And then if you can understand those, then you can make money on it, right? So I write about that strategy quite a bit. And then I think the person that probably whose strategies I resemble the most, little Peter Lynch. As time has gone on, what I like about him is, and I think what investors can really learn, is he didn't have one strategy. I mean, the danger of having there's two big dangers of having a single strategy. The first danger is that you get into a situation where everybody else starts using your strategy. And as good old Howard Marks taught us in The Most Important Thing, you have to be contrarian and you have to be correct. Well, you can't be contrarian when most of the other people in the market are looking for the same stocks with the same profiles, using the same strategy that you are, because there won't be any good deals. You can't be a contrarian. And we see this in the bubble with boomer, I call them boomer stocks. They have well-known brand names. They usually pay a dividend. They have steady earnings. They've been around a long time. They're usually pretty high quality businesses, and um, retired investors, of which there are a lot now because the baby boomer generation was so big and so wealthy, they and interest rates have been low until this year. They look to these kind of safe feeling stocks, and they've just bid up the prices. So if you're like a dividend growth investor, if you like any sort of yield or high quality, well known businesses, good luck finding very many of those, because that's what all these retirees are looking for right now. And so they're paying really high prices for them, which means they'll get low returns going forward from here. And you, if that's your strategy, if you were a dividend growth investor or something like that, in 2012, you've done really well, because during this time, all these people were being attracted to that style of investing, right? But going forward from today, that's not going to be a good strategy because people have paid too much for those type of stocks. So that's where Howard Marks is really important with you have to be contrarian. You cannot, because it's reflected in the price. The popularity of something is reflected in the price. So if you only have one strategy that you have adopted, and that strategy becomes adopted by a lot of other people, you're not going to get you're just not going to get good returns, unless you're super concentrated, which brings some risk, a lot of risk actually, I think. But if you're really good and you can pick the 3 best dividend growth companies for the next 10 years, you'll do well. But I don't think most people have the talent to do that. So, and then the other problem with only having one strategy is people really become ideological about these investment strategies. I mean, for me, I don't care. I want a strategy that works, and I use multiple strategies, which is what Peter Lynch did. And at one time, maybe one of them isn't working. I'll buy a dividend growth stock if it's cheap, and the forward returns look good. I've owned plenty of them. But that's not the only thing I can do, right? So I can find growth stocks, I can find cyclicals, and I can turn that over every 3 or 5 years. And if cyclical, well, like during this last cycle, semiconductors never fell very much in March of 2020. And then they had kind of this super upcycle. Well, I didn't own any because they never got cheap enough, so I missed that upcycle. But now I'm also mostly missing the down cycle. But the point is, there weren't any opportunities there, so there really weren't very many safe cyclical opportunities. I mean, I found a few of them, and they worked out pretty well, but we got really lucky with the government stimulus money and everything. So it wasn't particularly safe, and sometimes people forget what it's like to invest when the market's falling like 10% a day or something like that. You really need to believe in a cyclical business when it can fall, like lose half its value in a month, right? So you have to really have conviction that it'll come back. And some of these things just weren't going to, like airlines, and that's a separate topic. But the point is, when that opportunity is taken away, it really helps to have other opportunities and other strategies that maybe you can go find something in. So that's why I think Peter Lynch is really important for people to understand, and probably most closely resembles what I do. He had a cyclical strategy. He had a growth strategy. He had, I think he even had kind of a standard value, but he was known for growth at a reasonable price, being unconcentrated, but also letting his winners run, which is also what I do. So I have a lot of positions, but I don't trim them if they're growing, just because they got big. I want them to get bigger. As long as everything else still looks good, I keep holding on to them. So he did a lot of things like that. He had a lot of like early franchise things that he focused on, and just had kind of some unique approaches that other people weren't using at the time. So all that is really important, and nobody has to, and really all these have to kind of fit your own personality. You have to be able to pull it off. It helps to understand the theory behind the strategy. A lot of I'm buying a lot of growth stocks. I get a lot of questions when these stocks move like 8% in a day, and people are like, "Well, what do you think now?" I'm like, "Well, think the same thing that I thought when it was 8% higher or 8% lower or whatever." This is like a 5 or 10 year thing. I mean, you can I don't want to say completely ignore it. I mean, if something really crazy happens, you might need to do something, but for the most part, you just wait and find out if you're right. And you have to wait years. So that's how that strategy works. Now, every strategy is like that. My cyclical strategy happens usually within a couple years, right? But a daily or monthly change in price doesn't really affect it. So you have to kind of understand how the strategy works and be willing to just accept like what comes along with it. So for me, now that I've covered every major investor that I've ever read, what I try to do is aim. I think of it this way: Buffett got 20% a year returns for his 50-year career plus year career. The average return is, we'll say, it's 10%. From the S&P 500 in modern times. Looking forward, using my valuation techniques, it looks like from here the S&P 500 is 6 or 7% over the next 10 years per year. So I say, some people will say, well, there's no, either you're Buffett or you're indexing. And I say, well, there's a big gap between 10% and 20% a year returns. And an above average investor that gets 12 or 13 or 14 or 15 is going to do really well. So to me, it's worth learning how to try to get better than average returns, even if you might not get Buffett returns or Peter Lynch returns or, Howard Marks returns, who was really a bond investor. So, so my goal is like 15 to 20% a year, or if it's like a down time like it is now, then I just want to do better than the S&P 500 during those times. But yeah, like 15% I think is a reasonable goal, and even if you get close to that, you're going to do really well. So my time frame is usually, if I had to pick like one kind of set, like 5 years is usually kind of the sweet spot, 5 to 10 years. In practice, I have some that are shorter. We just had a really short cycle, so it's been more like 2 years on a lot of stuff, but I expect over time that'll get stretched out. I'll have some stocks that I just keep holding, and so that kind of 5 year mark is usually where I'm focused at. Like I consider that like medium term investing. It's not like super long, but it's not, most of the market is focused within 12 months, so it's longer than your average, but not so long that it's way off in the distant future, and you can have to use your imagination what the future's going to be like. In terms of concentration, I'm unconcentrated, 50 to 100 stocks, 1% or 2% weightings when I first start a position. And then diversification, I'm mostly in stocks, but because there are cycles, I didn't pull a Ray Dalio book up, maybe, but because there are debt cycles and things like that, I'll hold cash sometimes. That's to kind of diversify in that way. And then I will also buy, if they have ADRs that are listed in the US, I'll buy international stocks. I'll buy different types of stocks, different types of strategies. And so I would consider myself diversified, but not so much into bonds, because I think stocks are better for the time frames that I'm that 5 to 10 year time frame. Usually stocks are going to outperform. If it's one of those periods where they're not going to outperform, hopefully I have enough cash to kind of soften the blow down and then buy stuff when they're cheap. So that's kind of how I deal with it, instead of like a 60-40 portfolio or something like that. So maybe that gave you something to think about, just to make sure that whatever strategy you decide to use is coherent, like that it makes sense, maybe that you understand the strengths and weaknesses. Because when I look out, I see a lot of people whose strategies just don't make any sense to me. And they might not lose like a bunch of money, but they're not going to make as much money as they could. Well, if they're Cathy Wood, they'll lose a lot of money, but you can be conservative and maybe lose your money to inflation, which is what a lot of people are going to do, I think, and just generally underperform. So you have to save more money, or you can't. If you get to retirement, if you're saving for retirement, then you can't do the things that you would have been able to do if you got better returns. So it's not just black or white, do great, do poor. You could just, a lot of people, if they don't have a coherent strategy, they just aren't going to do very well. Certainly not as well as they could. And we're at a period now where the average return is probably 6-ish percent, 7% for the S&P 500 over the medium term. And that's not great. People that are used to getting double that the past 10 years are going to be in a little bit of shock, I think. So even if we don't have a giant sell-off, even if we don't have a horrible bear market, it's possible the returns are just kind of crummy, right? All right, I think that's it. I kind of went through everything. I could probably put together a more formal presentation of this, and I might do it at some point, but that would take a lot of time, and I really just wanted to talk in general and kind of plant the seeds maybe of a future conversation. So Corey Kramer, Cyclical Investors Club. It's $30 a month through Seeking Alpha's marketplace service. I'll have a link down below. And that's where you can get access to all the other stuff that I don't talk about on YouTube or Seeking Alpha. And I'll see you guys later. Bye-bye.